So we came into this meeting with a feeling of a lack of cooperation because of trade issues. How did the meetings feel once you got in the rooms?
Well, there's no question that there's a cloud over the conversation given what's happened this week. But we have a wide and varied agenda on which we can be constructive. So I'd say that the tone was constructive, and that's positive.
To what extent was the distraction of discussions around trade and tariffs taking away from some of the meatier issues that you came in here to talk about?
Well, basically we tried to prevent that by having a discussion about trade that was separate from all the other things. And so, okay, we're going to talk about that. Now we're going to move on and talk about other things, and we know it's there. It's an issue for everybody, but it's an issue which really needs to be discussed in full detail at the Leaders Summit.
And when central bankers come together, I know one of the themes you guys were discussing was rate policies in uncertain times.
Yes.
Obviously, one of the uncertainties is trade issues, but there are many others in the world today. What does that mean exactly in a practical way? What are the uncertainties you're grappling with as a group?
We try to classify those. There's, as you know, a whole range of uncertainties, but things that are most topical are like, what is potential output? How much capacity do we have in our economies? How far can they grow before inflation actually becomes, reasserts itself in a normal way? How high is our star? Or how low? What is our star? Those two assumptions alone and their intersection give you all kinds of scope for uncertainty and ranges around things that you're looking at. And I think that we focused a lot on those things and the inputs that we need to be more definitive about those things. And for one interesting outcome is that if there are any nonlinearities in your model, which most of us have, it means that even though you think of uncertainty as symmetric, it gives rise to asymmetric risk in your decision making. So the intuition would be, well, downside risk feels the worst right now given what we've been through. Even if risks are symmetric, you still care more about the downside risk. And that's because of the nonlinearities in the model.
So how does that inform policy?
Well, what that does is it means since we don't know exactly where we are, it is a risk management decision. And so as we've discussed for Canada, it means that you believe the skew is a positive one. And that means that there's probably more room to grow before inflation pressures are actually evident. But you don't know that for sure. And so it's a risk management decision, not a definitive decision. So it shades your judgment in that direction.
Are we changing, recalibrating the amount of inflation we're willing to tolerate, even in the models, than we did a few years ago?
No, I don't think so. Certainly we aren't. For us, it's about over that 2-year horizon, where will inflation be? And our forecast is it'll be as close as anything to 2%. But our forecast also shows that it could go like 2.5 or something like this in between now and then. And we say, well, that's okay because we believe it to be a transitory phenomenon. So there's a tolerance if we can explain it and it's transitory, but not in a targeting sense. We would not target above 2%. But again, since it's 2 years from now, you don't really know what it will be. And so it's a question of what are the upside and downside risks, and if they're asymmetric, as I mentioned a moment ago, then you say, well, I can wait a little bit longer before I'll see those inflation pressures showing up relative to my model.
It feels as though there's a bit of a tension between central banks and finance ministers, treasuries, in terms of continuing to need to stimulate growth and a willingness to take on debt to do that, and banks that are now looking to normalize. How does that play out in your view?
Usually fiscal policy is just something the central bank takes into account. It's not a big game where it's all coordinated. Governments have a range of objectives that they're pursuing. And so once they lay out their fiscal plan, then the central bank can kind of take that into account and know, well, relative to potential, this is where we'll be, therefore this is what rate path will look like. So I've usually thought about this as kind of a mixed question rather than a what's total aggregate demand question. And we all know that for the last number of years, interest rates have been extraordinarily low. If over that time period fiscal policy had been more stimulative, they could have been a little bit higher. And what would be the outcome? Less financial stability risk, less private sector debt, but more public sector debt. So either way, there would have been debt. And it's not black and white about which is worse. It's about understanding the trade-offs, and then judging. Now we use a framework called GDP at risk to try and bring those things into a common environment, to know that a prolonged period of private sector debt accumulation gives rise to a higher probability of a financial crisis or what have you, which puts the economy at risk. And so we take those things into account in that way.
It does seem by a number of measures that indebtedness is now running at levels, not just the measures we've been following for many years, but market measures, kind of flashing red.
Yes.
How does that factor into decisions that central banks will make, and in fact your fiscal counterparts will make?
Well, you're right in your premise. This is no question that during this long, prolonged cycle of below average performance, in various forms we've accumulated debt. It's household debt, corporate debt, and many countries also fiscal debt. And so our belief is that that's just an unusual cycle, and that we're converging back to a normal economic performance, and that'll give us a period during which those debts will, relative at least to the size of the economy, will recede in importance. So a bit of a normalization of that. Will debt still be there in 10 years? Yes, it will be. But the sustainability of it will improve through time as the economy grows at its potential rate. And but how it affects policy today is just taking it into account. Knowing it's there means understanding when interest rates are normalizing, they'll have a bigger effect on underlying behavior than they otherwise would. And so you have to take that into account in terms of pacing and understanding where your destination is.
One of the markets we watch in Canada, particularly for the economic knockover, is the housing market.
Yes.
And we have seen an effect of new regulations. Is it enough? Are you satisfied that we've found kind of a stable place?
I think it's a little early to make that conclusion. And we know when we had a year and a half ago, we had the changes in the Vancouver market, and there was an initial effect and then a bounce back. And that just shows you that Mother Nature is still there, that the fundamentals for housing remain quite strong. And I think the same thing is there in Toronto. That's what it looks like. There's very, very strong fundamentals. This was never about controlling prices or the housing market. It was about improving the quality of indebtedness to make it more sustainable. And by all counts, that's looking like that is moving in the right direction. We'll have a lot more to say about that next week when we put out the FSR, but it's encouraging. But as judging the new rules around mortgages versus slightly higher interest rates and the net or the total impact on housing, it's simply too early to sort them out. We'll need more data.
In terms of the risks in the world, what's the biggest thing you're watching right now that might affect the Canadian economy?
Well, trade risk. The risk around Nafta or actions taken outside of Nafta. At a minimum, just the discussion of it for the last 18 months has got everybody's radar on full, and companies postponing or delaying important decisions or making decisions that are different, investing in the United States or what have you, just to hedge against the risks that present. And unfortunately, these are decisions that only come up once every few years. They're highly strategic decisions for a company. So if we lose an investment because of that, well, we're not going to get that investment back just because Nafta gets cleared up. It'll be an opportunity lost. So we've identified an effect already, even though Nafta still is in effect, on the economy due to that.
There is some evidence that our manufacturing base in Canada is running close to capacity.
Yes.
Now is the time for new investment.
Right.
Is the risk that that investment doesn't happen because of all of these uncertainties?
Yes, there's a risk of that, and we have anecdotes, companies that have told us that they aren't. And yet at the same time, the investment numbers have been pretty good. Actually, the latest ones this week were quite good. And imports of machinery equipment, which is another important indicator, are also very strong. And the sentiment indicators have been good. So what that tells us is that companies are getting on with it on average. The anecdotes that are negative, of course, stand out in those conversations. But it suggests only that investment is lower than it otherwise would be, but still is making a significant contribution to growth. So encouraging that underneath that we still have the usual forces acting and in a positive way. So we have to wait and see just how this ends up.
All right, we'll leave it there. We appreciate your time.
Always a pleasure, Amanda.
Thank you so much.